Welcome to the asynchronous portion of Week 4. Having covered the Asia region and discussed the Cambodia-focused case study during our interactive Zoom session, let us now shift our attention to another promising emerging market region, that being the Middle East and Northern Africa region. We shall begin our discussion by reflecting on whether or not the Middle East as a whole, and some regional economies in particular, might be poised to become a new leader in the emerging market landscape. As an obvious starting point, and building on our earlier discussion of economic development and growth in emerging markets, it is only logical to focus on the degree and extent to which oil-rich Middle Eastern economies have begun or are poised to begin thinking about moving on from a near-exclusive reliance on natural resource exports and building a more diversified economic basis. In that context, we will also shed some light on the notion of vulnerability of success, particularly as it applies to some of the wealthy oil-rich economies. That discussion will then invariably lead us to reflecting on regional demographics, levels of unemployment, and by association, the very real potential of political unrest. And indeed, as you may already be very well aware, unrest and instability are unfortunately more the norm than the exception for some of those regional economies. One of the most vivid and, comparatively speaking, recent developments that came to define the socio-political and socio-economic vulnerabilities of many Middle Eastern and North African economies was the onset of the Arab Spring beginning in December 2010. Following this very general and brief contextualization, we will then move on to take a general look at the Middle East as an investment destination. And finally, I shall offer a few remarks about three regional economies: Saudi Arabia, Iran, and the UAE, the United Arab Emirates. To complement these brief country vignettes, I will also post a few insightful video clips about each of those economies at the bottom of the Week 4 asynchronous session Canvas page. So without further ado, let's get started. Let me begin by stressing two main points. First, considering the overall geographic extent of the region, it should not come as a surprise that I will not be able to do justice to each economy, and I have made a conscious decision to highlight three of them. Of course, this does not mean that the other regional economies are not deserving of a more detailed discussion and analysis. In fact, in many ways they are, but unfortunately, we just do not have the time today to devote a serious and detailed examination to each of them. And I hope that some of you will have chosen one of the MENA economies to write your paper about. The second point pertains to the geographic definition of MENA. If you were to Google the term MENA and look for illustrative maps, you would undoubtedly stumble across versions of the one I have displayed on this slide. You would also, however, find some maps that will include additional countries. In some instances, those would be Sudan and South Sudan, as well as Somalia. This goes to show that there are varying interpretations of the geographic scope of MENA. Yet it is decidedly outside the purview of this course to debate which one of the geographic interpretations is more accurate. So instead, I have opted for our purposes to define MENA based on the regional map that is displayed here. On September 27, 2017, Forbes magazine ran an article titled "The Middle East, a New Leader in Emerging Markets." Underscoring this headline was the fact that PwC, in its most recent Middle East Economy Watch report at the time, pointed to a wave of aggressive fiscal reforms and forward-looking policies as the main forces that had begun to attract foreign investor attention. Among the promising steps taken were cuts in energy subsidies across Gulf Cooperation Council or GCC economies, overall cuts in expenditures, and the announcement of an introduction of a value-added tax by 2018. The adoption of that tax by the GCC countries, it was reported at the time, could potentially lead to, quote, as much as $25 billion in additional revenue, which could be used to further develop much needed investments and boost their economic activity, end quote. Indeed, a number of regional economies have distinct economic potential, but this should not distract from the fact that much work still needs to be done. Meanwhile, the COVID-19 pandemic certainly did not help growth prospects. As the International Monetary Fund noted in its October 2021 Regional Economic Outlook, and I quote, "The recovery in the Middle East and Central Asia region is uneven and incomplete and must fully take hold throughout the region," end quote. At the same time, renewed hope was also on the horizon. According to Jihad Azur, the director of the Middle East and Central Asia Department at the International Monetary Fund, quote, "We project real GDP growth for countries in the Middle East and North Africa to expand by 4.1% in 2021 and in 2022, after contracting by 3.2% last year," end quote. At the same time, however, when announcing the October 2021 Regional Economic Outlook, the IMF Media Center also noted, quote, "This year's projection is a marked improvement from the last year's sharp contraction. Yet the recovery has been uneven and the success of the vaccine rollout varies widely, with low-income countries and fragile and conflict-affected states showing limited progress," end quote. Of course, as we already established in week 1, investing and operating in emerging and frontier markets is not for the faint-hearted, and a long-term outlook is warranted. As such, if some of the regional economies have been able to build up and strengthen economic fundamentals and coupled them with forward-looking policies designed to improve overall economic competitiveness and diversification, the long-term economic picture should well be a promising one. For resource-rich regional economies whose fortunes have been based on natural resource exports, the fundamental challenge remains one of diversifying the economic base and gradually reduce reliance on fossil fuel exports. This is largely due to the fact that commodity price exports, as we had previously already established, are notoriously vulnerable to commodity price fluctuations. And this, of course, leads to the obvious question of how long oil-rich Middle East economies can absorb the revenue shocks of depressed oil price levels. Even a cursory glimpse at this chart, which traces the monthly average Brent crude prices, helps to put the economic challenge into perspective. Over the course of the second decade of the 21st century, we notice a significant and continuous contraction in crude oil prices. This price drop is all the more disconcerting for economies where the hydrocarbon sector accounts for a significant chunk of national GDP. Between 2012 and 2018, the percentage contribution of the hydrocarbon sector to GDP in GCC countries has dropped most notably in Kuwait and Qatar, but still remains exceedingly high at approximately 53% and 40% respectively. In Saudi Arabia, Oman, and the UAE, meanwhile, the percentage drop has been even lower. Compared to other GCC economies, the hydrocarbon sector contribution to GDP in Bahrain is the lowest at just under 20%, but it has also remained virtually unchanged between 2012 and 2018. If we look at it from the perspective of total revenues, we notice relatively little change between 2012 and 2018 for the economies of Kuwait and Bahrain, for both of which the drop has been marginal. When it comes to Qatar, meanwhile, hydrocarbon revenues as a share of total revenues has actually increased slightly over that same time period. On the other hand, the situation in the Kingdom of Saudi Arabia and the UAE is rather encouraging by comparison. In Saudi Arabia, hydrocarbon revenues as a share of total revenues has dropped from slightly more than 90% in 2012 to just under 70% by 2018. A development that may very well be attributable, at least in part, to Mohammed bin Salman's Saudi 2030 vision, which I will explain a little bit later. In the UAE, meanwhile, the share of hydrocarbon revenues appears to have nearly dropped by half, fueled with significant extent by ongoing economic diversification efforts, including tourism, logistics, and financial services, to name just a few of the more prominent economic growth sectors. This third chart, meanwhile, paints an unmistakable picture of the vulnerabilities associated with the resource curse and lack of economic diversification. In the case of Kuwait, for example, the share of non-oil and gas exports is truly minuscule and worrisome, compared to Bahrain and the UAE, where oil and gas exports make up roughly 50% and 55% respectively. While decidedly not insignificant, both economies have been comparatively successful in efforts to diversify into non-oil and gas exports, thus effectively providing them an economic cushion against commodity price fluctuations. Qatar, the Kingdom of Saudi Arabia, and Kuwait, on the other hand, remain disproportionately vulnerable to commodity price shocks. The underlying message of all of these charts is one of an inherent vulnerability of success. This perspective was compellingly articulated by Christopher Davidson in his 2008 book titled Dubai, The Vulnerability of Success. And allow me to quote from a review of the book that I wrote for the October 2011 edition of the scholarly journal Politics and Policy. Davidson, I write, offers a, quote, powerful argument that any economic success story, no matter how compelling, must not invite complacency, arrogance, hubris, or overconfidence, lest a confluence of internalities and or externalities put the sustainability of success at risk, end quote. I go on to say that, quote, Davidson's underlying argument is that contrary to seemingly matter-of-fact depictions and perceptions of Dubai as a Middle Eastern Shangri-La, a confluence of situational factors, whether political, economic, security, social, cultural, or demographic, unless appropriately managed, carry the distinct possibility of making Dubai's developmental model a mere superficial success, end quote. Incidentally, if you would like to read the full book review, I will be sure to provide a link on our Canvas page. But the fundamental point that I would like to draw your attention to here, and I'm sure you have already picked up on that, is that natural resource exports and the accumulated wealth therefrom may very well fuel socioeconomic development in the short to medium term, but it is not a guarantee for long-term socioeconomic and sociopolitical stability. In fact, many resource-rich economies, as we had previously established, run the distinct risk of not only structural corruption and or the establishment of a rentier state, but also of socioeconomic wealth gaps resulting therefrom. And it is that reality, if largely unaddressed by the political elites, that raises the possibility of broader societal unrest, which can very well endanger the overall developmental progress that was made up to that point in time. The events of the Arab Spring helped to put this vulnerability into stark perspective. The literal spark that ignited the fire of the Arab Spring originated in Tunisia on December 18, 2010, when a fruit vendor named Mohamed Bouazizi had his cart apprehended by local police because he did not have the necessary permit. He subsequently visited the local government office to make his case and request that his cart be returned to him, for after all, selling fruit was the only means for him to sustain his family. That attempt, however, ultimately proved unsuccessful, and in an act of desperation, Mohamed Bouazizi doused himself in gasoline and lit himself on fire to protest the injustice that he had been confronted with. His actions indeed served to highlight the glaring socioeconomic challenges facing a large segment of Tunisians at the hands of the regime of President Zine El Abidine Ben Ali, which had been defined by widespread corruption and economic stagnation for quite some time. The lack of economic prospects had long since given rise to simmering tensions, but the immolation and subsequent death of Mohamed Bouazizi fueled the fires of revolution that ultimately led to the ouster of President Ben Ali. And from Tunisia, protests subsequently spread to other regional economies, notably Libya, Egypt, Yemen, Syria, and Bahrain, resulting in the fall of, among others, Egypt's long-standing autocratic leader Hosni Mubarak, as well as the ouster and subsequent execution of Libya's Muammar Gaddafi. Overall, the uprisings that engulfed much of Northern Africa and spilled over to the Arabian Peninsula were largely fueled by the volatile combination of large youth populations and high levels of unemployment. In other words, the youth bulges in many of these economies proved decisively not to be a demographic dividend, a possibility that we had previously introduced in the economic development and growth discussions. Indeed, as you might recall, the latent energy of a youth population can only be meaningfully channeled into economic growth and development through broad-based access to quality education and by effective economic management and efficient resource allocation, all of which would lay the foundation for decent job opportunities. In the absence of economic growth and job prospects, however, frustration among the young generation is bound to build up and ultimately erupt into large-scale societal discontent. To put it differently, the writing was most decidedly on the wall, but the governments of many of these regional economies, for whatever reason, appear to have made a conscious decision to ignore those warning signs. Of course, it is easy in hindsight to make this argument, but nonetheless, it should be expected that people vent their frustration when confronted with lack of opportunities for themselves, while at the same time being witness to state capture by political elites on the most brazen of levels, with bribery, corruption, and blatant disregard for the needs and concerns of society at large being the hallmarks of the political regime. To get a better understanding of the truly explosive potential of the youth population in the Middle East and Northern Africa region around the time of the Arab Spring, all you need to do is to look at a range of basic socioeconomic indicators such as GDP per capita, the overall youth share of the population, specifically the percentage of 15 to 24-year-olds and or 15 to 29-year-olds, the net enrollment rates in secondary school, and the overall youth unemployment rate. In the PDF version of this presentation, I will include these data points for each one of the blue-shaded MENA economies on this chart. Let us now shift gears a bit and focus on what factors and developments help to make Middle Eastern economies potentially attractive investment opportunities in the medium to long term. Keep in mind that, once again, the discussion that follows is meant to only provide a very general and initial context. To provide you with additional perspectives, I have also assigned 2 readings from McKinsey that are quite insightful. The 2019 publication titled Where Next for Business in the Middle East focuses on the shifting competitive landscape, shaped as it is by changes in consumer tastes, the emergence of new digital champions, and the deregulation initiatives pushed by various governments, and what it all implies for the future of business in the region. The Entrepreneurship in the Middle East and North Africa publication, on the other hand, outlines 6 best practices that will allow public and private investors to, quote, support and enable the growth of the region's burgeoning startup ecosystem, end quote. So I strongly encourage you to consult those publications for a more detailed elaboration of the latent growth and investment potential in the Middle East and Northern Africa region. PwC has identified a set of 5 megatrends that help inform one's assessment of underlying risks and growth opportunities in the MENA region. The first megatrend centers around demographic and social change. The demographic trends present both challenges and opportunities. 40% of the population in the MENA region is under the age of 25. Between 1995 and 2015, the population of the Gulf Cooperation Council economies has doubled to 51 million, and youth unemployment, at 28%, is one of the highest levels in the world still. Combined, These realities constitute a volatile mix as evidenced by the Arab Spring uprisings in the early 2010s. Now, combine that with sobering predictions of a population growth rate that at 50% over the next quarter century will outpace India, and that by 2050, the percentage of elderly in the Gulf Cooperation Council economies is expected to hit 20%, which is 4% above the anticipated global average. And the urgency of nurturing and supporting the brain power of today's young generation becomes readily apparent to sustain economic growth and prosperity. On a more positive note, meanwhile, geographic location puts many of these economies at or close to the 21st century global economic center of gravity, thus in effect raising the possibility of straddling critical 21st century global economic trade routes. China's Belt and Road Initiative, for example, might come to play a crucial role in this regard for the region. The Middle East is already one of the most urbanized regions in the world. As new cities continue to be developed, however, much of the region will also have to balance expanding urbanization with environmental sustainability. Several regional economies are pursuing new visions to optimize urban development. These include projects such as Saudi Arabia's Oxagon, which is part of the NEOM project in the northwestern Saudi Arabia region. Oxagon, as described on the official NEOM website, aims to, quote, contribute to redefining the world's approach to industrial development in the future and protecting the environment while creating jobs and growth for NEOM, end quote. In the UAE, Masdar City, which is located on the outskirts of Abu Dhabi, as described on the official website, is, quote, a pioneer in sustainability and a hub for research and development, spearheading the innovations to realize greener, more sustainable urban living, end quote. The growing pressures of climate change and resource scarcity merely help to provide a further impetus for the pioneering urbanization projects. The fact that these initiatives originate in the GCC economies is no accident, considering that they rank among the world's highest consumers of energy and water per capita. The situation will only become more urgent when considering that GCC economies already depend on desalination technology for 70% of their water supply, and that in 2016, PwC forecast water consumption to increase by nearly 1/3 over the next 4 years. Challenging though many of these megatrends may be, technological breakthroughs may well be harnessed to mitigate or minimize some of the more pressing challenges, provided MENA corporations and governments embrace digitalization in the most concerted and deliberate manner and prioritize as well as actively support digital innovation, research and development, and the development of new technologies. While definitely possible, it will require a concerted recalibration toward R&D. Given that in 2016, as reported by PwC, R&D expenditures in both Saudi Arabia and the UAE, at approximately 1% of GDP, were not only behind European averages, but were in fact left in the dust when compared to technological powerhouses such as South Korea, which committed no less than 6% of GDP to R&D efforts. In short, the challenges are real, but so are the prospects for success if all the right resources are marshaled and a deliberate course to economic diversification and sustainability is charted by national governments. For the remainder of our Middle East and North Africa region overview, I would like to briefly highlight 3 emerging or frontier market economies, beginning with Saudi Arabia. On March 28, 2018, the FTSE Russell Index announced the classification of Saudi Arabia as a secondary emerging market within the FTSE Global Equity Index series, as part of the country classification interim update. This certainly was a promising development, but the more immediate question that might be weighing on your mind is, what led to this reclassification? By the time of its reclassification, the Saudi economy, at approximately $684 billion in nominal GDP, was not only the largest economy in the Arabian Gulf region, but was also ranked fourth in the overall emerging markets universe, excluding China. Moreover, based on its gross national income per capita of approximately $20,000, the World Bank classified Saudi Arabia as a high-income economy and outclassed most of its emerging market rivals. Notable though these rankings might be, they would not necessarily by themselves provide the most compelling rationale for reclassification. What seems to have worked in Saudi Arabia's favor, however, is a high-profile and ambitious initiative championed by none other than Crown Prince Mohammed bin Salman to dramatically lessen the country's dependence on the oil sector for sustained growth and development going forward. The initiative in question is widely known as the Saudi 2030 Vision. It is an ambitious and comprehensive plan for economic transformation that aims to achieve a range of strategic goals related to economic diversification, business environment improvement, capital market liberalization, and social reforms. Some of these specific goals include increasing the private sector's GDP contribution from the current 40% to 65%, raising non-oil export contributions to GDP from 16% to 50% by growing the mining, tourism and entertainment, logistics, and housing construction sectors. Boosting the GDP contribution of small and medium-sized enterprises. Lowering unemployment from 11.6% to 7% while increasing the participation of women in the workforce. Developing infrastructure by expanding high-speed broadband coverage and building a competitive renewable energy sector. Bringing 50% of its military equipment spending in-house. Adding 500,000 new private sector jobs by 2020. And increasing foreign direct investment in line with more developed economies. Now, if you'd like to know more details about this consequential vision, I will post a link to the official government site on the Canvas page. A further compelling rationale driving the reclassification effort was the Saudi government's decisive move to liberalize its capital markets infrastructure beginning in 2015. In mid-June of that year, as reported by FTSE Russell, the country announced an end to the long-standing policy that had effectively limited direct investment in the shares of Saudi Stock Exchange-listed companies to Saudi and resident foreign investors as well as other GCC investors. Until that policy change, non-GCC foreign investors had only been granted indirect access to Saudi-listed stocks through derivatives and investment funds. The change in capital markets policy, according to FTSE Russell, not only, quote, set eligibility and registration rules for qualified foreign investors, or QFIs, end quote, but it also paved the way for a much more streamlined QFI registration process by 2017. On the back of these promising developments, it appeared as though Saudi Arabia could well be poised to emerge as the hottest emerging market by 2018. In fact, during the first quarter of 2018, Saudi Arabia registered $110 million in net inflows of equity funds investing, and the subsequent 7% gain in the stock market easily outpaced many other indexes at the time. Sami Kaelo, the CEO of Morgan Stanley Middle East and North Africa, summed up the prevailing optimism when he noted, quote, strong underlying fundamentals supported by the government's efforts to diversify the economy will translate into increased investment activity in the kingdom. Notwithstanding these encouraging signs, it still remains to be seen how quickly and concretely Saudi Arabia can retool its economy in response to shifting economic sands with its ambitious Saudi 2030 vision. The oil price war of 2020, which was launched by Saudi Arabia, is a case in point. The decision to increase supply of oil at a time of rapidly declining demand, which was largely due to an economic slowdown brought on by the onset of the COVID-19 pandemic, led to a crash in oil prices below the threshold level needed to be able to balance the national budget. Now, if you'd like to learn more about the continued challenges facing Saudi Arabia, I invite you to check out this brief 13-minute video clip that aims to shed light on whether or not the Saudi economy is in crisis. I will post this video link at the end of the lecture video together with other related optional clips. The second economy I would like to highlight is Iran. A frontier market, it holds obvious risk factors, but also tantalizing opportunities that have multinational companies eager to break into the market and establish a foothold. Of course, owing to Iran's pariah status, dating back to the days of the Islamic Revolution of 1979 and the 8-year war with Iraq from 1980 to 1988, although I should mention here that Saddam Hussein's Iraq had actually launched the war in a kick them while they're down effort to take advantage of chaos surrounding the early days of Ayatollah Ruhollah Khomeini's regime. And then, of course, there was the sanctions regime that had been imposed on Iran in response to the regime's nuclear ambitions. The 2015 nuclear deal, officially known as the Joint Comprehensive Plan of Action, or JCPOA, signed with the P5+1, that is, the 5 permanent members of the UN Security Council plus Germany, gave rise to renewed optimism about the Iran market opportunities, given that in exchange for agreeing to dismantle much of its nuclear program and submit to comprehensive nuclear facility inspections, Iran would be granted significant sanctions relief. Anticipating broad-based access to the Iranian market with a young and cosmopolitan population, the conditions seemed right for a billion-dollar growth opportunity, and Iran appeared poised to become the best emerging market for years to come. Notwithstanding the opportunity hyperbole, the general excitement seemed rather justified when looking at the broad situational realities on the ground. Despite having been kept in check under a long-standing sanctions regime, Iran remains the 23rd largest economy in purchasing power parity real GDP terms and has a sizable productive capacity as well as significant market potential. In recent years, it was also estimated that 56% of Iranian households have incomes exceeding $20,000. Even though real GDP per capita has been contracting slightly from $13,500 in 2018 to $12,400 in 2020, according to the CIA World Factbook, the market potential remains strong. Additionally, Iran boasts a very young population. Of its nearly 86 million people, 15 to 24-year-olds make up 13.36%, and 25 to 54-year-olds nearly 49%. Combine this with the fact that much of the population is urbanized, well-educated, technologically proficient, and rather entrepreneurial, and it is easy to appreciate the broad-based opportunities that market opening would present to foreign investors. From a natural resource perspective, Iran also stands to benefit from having some of the world's largest natural gas and oil reserves. Of course, as we know by now, that could also very well make the country vulnerable to the resource curse unless these resources are efficiently used and do not detract from the overall need for economic diversification. And finally, Iran's geographic location, straddling the length of the Persian Gulf and giving it de facto control over the Strait of Hormuz, Iran is rather conveniently located to capitalize on the potential of a major regional entrepot between East and West, and could well, if economic opening up proceeds and concerns of its nuclear programs were to fully subside, which has not been the case following the tearing up of the JCPOA by the Trump administration and Iran's subsequent move to restart its nuclear program. But it could compete with Dubai as a major transshipment hub in the future. A comprehensive situational perspective, of course, also points to lingering challenges that might complicate Iran's frontier or emerging market potential, even in the absence of renewed concerns over its nuclear ambitions and associated security concerns. On the one hand, Iran exhibits definite signs of so-called institutional voids, as evidenced by the absence of independent regulatory bodies and intermediary companies that support market operations. On the other hand, its economy is also held back by a shortage of market research and end-to-end logistics providers, areas that would need to be significantly upgraded for foreign investors and multinational companies to take full advantage of the overall market potential. On the range of critical index scales, Iran also remains comparatively weak. It currently places 127th on the World Bank's Doing Business Index. Although there has been improvement in this area, considering that it had registered its weakest ranking, 152nd position, back in 2013, but it also dropped back 10 points from its best ranking, 117th position, which it achieved in 2015. The World Economic Forum's Competitiveness Index, meanwhile, ranks Iran 99th out of 141 countries. And a related Global Talent Competitiveness Index, which is compiled annually by the business school INSEAD, based in Fontainebleau, France, Iran ranked 100th out of more than 130 countries in 2021, which is 2 spots higher than in 2020. On the regional perspective, this meant that Iran ranked 6th among the top 10 countries in the Central and Southern Asia regions in 2021. So overall, Iran holds distinct potential, but whether or not the country can fully capitalize on that potential in the near term depends on the one hand on policies and priorities of the new Ebrahim Raisi government, which is certainly less moderate than that of its predecessor Hassan Rouhani, and on the other hand, it also depends on the developments in the broader external environment, notably on the nuclear and security front. And finally, let's take a quick look at the United Arab Emirates. Of all the Middle East and Northern Africa region economies, the country ranks decidedly among the most dynamic and attractive ones, not least because of the comparatively speaking progressive environment in Dubai, one of the 7 Emirates. Abu Dhabi, the capital of the UAE, enjoys significant oil reserves, which have helped fuel development, but have also not hindered a push into economic diversification in recent years, as illustrated previously in the form of expansion into sustainability and R&D initiatives at Masdar City, for example. Risk factors have also certainly been part of the UAE's development success story, as evidenced, among others, by the debt crisis that had come to a head in Dubai in 2009 on the back of state-owned holding companies that, under the behest of the Dubai government, had undertaken risky commercial activities. The unexpected removal of the heads of both Dubai World and Dubai Holding, 2 of those state-owned holding companies, on November 24, 2009, prompted the cost of insuring $10 million in Dubai debts to dramatically increase from $360,000 to $460,000 per year. At the time, the combined debt held by Dubai World was $26 billion, while the estimated debt levels of the top 3 holding companies, Dubai World, Dubai Holding, and the Investment Corporation of Dubai, stood at $80 billion. The overall combined debt burden of all the state-owned holding companies, meanwhile, was the size of Dubai's annual GDP. Now, Dubai ultimately weathered the crisis with the help of a bailout from Abu Dhabi, but it goes to show that even successful economies like Dubai's carry the risk of vulnerability of success, which we had previously referred to. All that being said, the development success can certainly not be denied, even if some of the prime exhibits of Dubai's success story seem like extravagances that range from the world's only 7-star hotel, the Burj Al Arab, the world's tallest building, the Burj Khalifa, the world's largest shopping mall, Dubai Mall, and mind-blowing real estate projects such as Palm Jumeirah, Palm Jebel Ali, and Palm Deira, or even The World, which is a set of man-made islands off the coast that were set to resemble the world map. Dubai and the UAE more broadly have also taken concerted steps towards economic diversification, including expanding into financial services, tourism, logistics, etc. The UAE is definitely an emerging market worth keeping an eye on, as long as you remember that risk factors are still lurking beneath the surface. If you'd like to learn a little bit more about this, I will include a few relevant video clips such as the one that I'm depicting here on our Canvas page as well. And with this, I conclude our rather general and brief overview of the emerging markets dynamics, trends, and developments in the MENA region. We will complement this regional overview in our Week 5 synchronous session with a case study about the decision by Diageo, which is one of the world's largest producers of spirits and beers, to expand into Turkey with the acquisition of a local company in 2011. So please be sure to read that case prior to our February 7th session. The asynchronous portion of Week 5, meanwhile, will feature a video lecture designed to give a general overview of Sub-Saharan Africa. So once again, thank you for listening. I hope you found the information provided here interesting and useful, and I look forward to seeing you for our Week 5 Zoom session. Bye for now.